What is going on, guys? I'm going to show you exactly how you can get instantly better at reading the stock market with one simple little tool I use, showing you how you can turn this right here into this right here. This is called a footprint chart, one of my favorite tools for reading volume in the market, and it's really a godsend once you kind of pick up how to use it. But before we get into how to use it, let's get into what it is really fast. So what this footprint chart is pretty fucking simple, guys. We have a normal candlestick and a footprint chart candlestick. So basically, this right here is showing you exactly what a candlestick is showing you, right? It's showing you the open, it's showing you the close, it's showing you the high and the low, just like a regular candlestick, right? At any given time frame, whether you want the 5 minute, 30 minute, 5 hours, 17 hours, 30 days, whatever you want, you can have it on the footprint chart. The difference is, right, it will also give you on the left-hand side all the sellers, all the aggressive offers, all the sellers who are marketing at the bid. They're selling at a cheaper price, right? Hence, they're being aggressive. And the other side is it's the opposite. It's all the buyers who are hitting the ask. They're market buyers buying at the ask, a higher price usually, meaning they are aggressive when it come into the market, right? And it also shows you the exact volume per tick. So every single candle you see, you'll see exactly how much volume is in every single tick of that candle, which is super useful for a lot of different strategies, right? Also plot for you the exact delta, right? Which is the difference in market buy orders and market sell orders. So it'll show you overall during that candlestick, was there more buyers? Were there more sellers? Was it neutral? Who's in control? What happened? And it gives you an easy read, right? With the delta, calculating it for you. Also the volume per candle. So you can see is price moving up or is price moving down? Is volume increasing? Is volume decreasing? Plus, where is the volume sitting on the candle, right? Is it more at the highs? Is it more at the lows? Because we know market's an auction, right? It moves based off volume. So it's trying to move up on lower volume. If the higher end of the candle has low volume, it signifies a reversal and kind of vice versa. So it can not only show you where all the offers are, right? Where all the buyers are, where all the sellers are, if there's more buyers, if there's more sellers, but it also shows you the volume, again, per tick, which is super, super useful, guys. Now, a couple more things it will show you as well. It will show you the point of control of the candle, which is the yellow line you see right here. And this is just the highest volume per point per candle, meaning that this candle, the highest volume was right here in this yellow line. This candle, the highest volume was right here in the yellow line. So you can actually see the point of control per 5 minute candle or daily candle. So you can see exactly where the most amount of volume was transacted, because we know volume moves the market. If there's a significant amount of volume at one specific price level, that level is important. You should probably start paying attention to it. It will help you read exhaustion right before we get into the nitty gritty. It'll help you see, okay, this candle right here, the histogram, right, this blue thing is showing you the volume, right? Showing you the thicker it is, the more volume, the thinner it is, the less volume. So you can actually see exhaustion as we push into a key level. If you see exhaustion, right, if you see transactions dying out, usually a good indication the market will reverse into higher price. But because if no one is transacting at lower price points, the market, again, has to advertise itself at a highest price point or higher price point to get people to come in and play. Also, not getting too ahead of myself here, we have these imbalances we're going to talk about as well that you can use on the footprint chart that would automatically be plotted for you, which creates some very, very strong levels for entries, for exits, and executions. But let's get into the best part first, right? We have absorption. Basically, this candle moved up, right? What do you see here? Super strong positive delta with high volume, but the market does not make any new highs, meaning that these buyers got absorbed by passive sellers. Versus this candle right here, where you have, this candle barely closed higher than it opened. This candle had negative 1,000 delta and it closed lower, price moved down. So absorption versus aggressive follow through. It could show you a lot about the market that you don't see using just regular old candlesticks. Because if you're looking at this just with boxes and lines, you would know what the fuck happened here, right? During this first candle into the zone, I would be like, okay, that's a lot of aggressive buyers with a spike in volume, but the market didn't really make any new highs. Actually closed pretty close to the open. The market will then go on, go on, go on. We break this imbalance. Okay, that balance being broken for me is a sign, right? We're not using fair value gaps with random boxes on a chart. We're using real data, right? So we just broke an imbalance, inverse a fair value gap, whatever the fuck you want to call it. Retested that shit, and then aggressive sellers come back in and start selling the market off. So just look at how useful this can be, guys. Instead of looking at random boxes and lines that don't mean jack shit, you can actually see real-time data, right? Real imbalances, what's actually going on behind the scenes. And you can use it in many, many different ways, guys. For example, right? You have 8:30 a.m. data days. Great play I like to use. Rally starts pre-market. This level is the previous day's value area. So it could be a supply, it could be, liquidity level, whatever it is. And the bottom of the consolidation range area could be the previous chop, a lot of different things you can use this for. It attracts a lot of selling as people are selling this rally. So for me, usually it's supply. So we come in, you see volume dying out at the level, right? Selling pressure comes in. Back at the rally, so back at data lows, we see all the significant buying pressure, all this delta. The market then starts moving up. right? Then look at the volume at this level, right? People who transactions died out, the reverse price, volume picked back up and now stacked at that level, indicating a breakout. So when I'm playing breakouts, I look for higher volume. When I'm playing reversals, I look for lower volume. And you can't see that on a candlestick chart, right? But you can see that on a footprint chart, especially if you have this chart open right here, right? Where you see the volume bars here, you don't know where that volume is. So this candle could have had low volume, but 100% of the volume could have been up here causing a breakout, or vice versa. This candle could have had a lot of volume, but all the volume could have been down here and not up here causing a reversal. And you wouldn't know that unless you're looking at a footprint chart. You wouldn't see the seller step in. You wouldn't see the buyer step in at the bottom. You wouldn't see any of that. That's why the footprint charts are so important to any strategy you're trading. It will increase your win rate. I can promise you that. Now, the next thing I want to look at is actually the imbalances that we're talking about. So these imbalances, right? This. There's 4 different types of imbalances. There's reversal imbalances and continuation imbalances, broken into 2 sections each part that we're going to go over. But these imbalances are how I actually use a footprint chart to enter into trades and not just analyze the market. So what are imbalances? So imbalance is a diagonal bid/ask imbalance, shows a difference in the number of buy and sell orders. When more aggressive buyers lift the buy or lift the offer, right? Buy at the asking price, or aggressive sellers at the bid, sell at the bidding price, indicates the market sentiment is leaning toward either selling or buying more strongly. But we'll show you exactly what I mean by that. It's a diagonal. So when imbalances are formed, it's not based off of, the 0 and the 6, the 0 and the 2. It's based off the 3 and the 0, the 2 and the 0. It's based off a diagonal divergence between the bid and the ask, not just the vertical one of the bid and the ask, or not just a diagonal or a horizontal of just the bid or horizontal of just the ask. It's based on a diagonal, right, difference in the bid and the ask. What it is doesn't really matter, right? Like what's a future contract? Does it matter? No, we don't need to know what it is to make money, right? But this is what it is. So it's an absence, right, of a balance between sell and buy orders, indicating one side is stronger. So it compares bid and ask diagonally and shows a significant excess of one over the other. So a bid is compared with an ask when one level is higher, and ask compared to a bid when one level is lower. An imbalance compares bid and ask diagonally and shows a significant excess in one over the other. It is a bid compared with an ask. So again, I'm just repeating myself here just so you can kind of have it implemented in your head that it compares this to this to this to this to this to this, which plots these imbalances automatically for you. Just kind of going back to this imbalance like this, a sell side imbalance you can use for actual entries. You see the market push up into here. What do you see? 8,000 positive delta, yet the market doesn't really make any new highs. The next candle you see super strong selling pressure come in and the market moves lower. So the buyers didn't get rewarded. Sellers come in and start getting rewarded off of a sell side imbalance. We'll talk about these imbalances more in a second here. But the volume dynamic is key because you can find a dead volume area in demand, for example, and use the market having low volume in demand for an entry, because if there's no volume in an area, especially demand, the market then must advertise itself at a higher price point to get people to come in and play, right? You can actually see the imbalances being made after you kind of have an aggressive sell-off from a level. So if you miss an entry in supply and an imbalance is made, you can use that imbalance as an entry tool, as an entry level. And these are the settings for my imbalances on Quantower. If you don't use Quantower, maybe try to transfer these overs, but save this, screenshot this, because we're about to get into what imbalances are and how to use them. Okay, so back onto this, right? What do you look for? So the imbalances are showing us a price level where there has been an abnormal amount of one-sided activity, right? For longs, for example, we want to see the volume die off at an imbalance or aggressive buyer prints coming in. For shorts, we want to see volume die off at the imbalance or aggressive sell prints coming in, right? And we're never going to go against the imbalances, but there's 4 different types of imbalances, right? There's 2 continuation imbalances and then 2 reversal imbalances. So the continuation imbalances are when you see an aggressive move, you see an imbalance being made, and then we get lower bids and lower ticks. So the continuation on the sell side, right, will be a red imbalance. And this is what you look for the market to tap back into for shorts. Continuation on the buy side is when you have an aggressive move up and an imbalance being made with ticks actually above the imbalance. And all you do for this is wait for the market to test the imbalance with that volume for continuation back up, right? And you can use this for take profits, for entries, for stop losses, a bunch of different things. Now, a reversal imbalance is the opposite. You got to think about it the opposite of a continuation. So when you see abnormal activity on the very top or bottom end of a candle with not even a single bid going above it. So a reversal buy side imbalance, right, will print at the very high end of the candle. Usually it'll be dead volume, right? And price does not go a single tick higher. It instantly reverses. Sell side on the other side is price does not go a single tick lower, usually low volume, and price instantly reverses. Now these are reversal triggers, but they're the opposite of each other, right? So when you see a green imbalance at the top of a candle, you're looking for shorts. When you see a red imbalance at the bottom of the candle, you're looking for longs. I know these can get kind of confusing, but really just think about it. The very high end, not a single bit above reversal, right? Not a single bit below reversal. But if you see a big imbalance be made after an aggressive move, It's a continuation, right? So any bids above or below, continuation. Any 0 ticks above or below, it's a reversal. Kind of think about it that way. Now, this is kind of how I actually will use these as an entry. So for in supply, we see a sell-off from supply. We don't get an entry in supply. Then we see an imbalance being made. I'm looking for price to retest an imbalance with dead volume for continuation down. Once I see that, I have to wait for the candle to close, make sure there's dead volume and imbalances do not get filled. Whenever the candle closes, I'm putting my stop loss right above the imbalance. I'm targeting VWAP, next coming liquidity level, next coming demand level, whatever's closer. Same thing on the other side, right? We get a push off demands as pre-market, right? And we get an imbalance made, continuation, because we made ticks above and we close pretty aggressively. And you see a retest of that imbalance with low volume. We're in long and we target whatever's coming next, right? Whatever's coming next. Now these have to be aligned with the overall structure and sentiment. This has to be aligned with, whoa, what is that sound? I don't know what that was. It has to be aligned with overall market sentiment and structure. It has to be aligned with the current supply and demand levels, and volume has to be on your side, which is why we wait for dead volume in these continuation imbalances. Now, again, there are some rules you need to follow with this, right? The imbalance must be either in supply or demand, or it must be from the candle that left supply and demand. If it's a random imbalance on a random level, on no key levels, a random spot on the chart in between two levels, whatever it is, if it's not in supply and demand or a candle that left supply and demand, I will not trade it. So if there is an imbalance kind of, away from level, the only thing I would use it for is take profit levels, right? So if I'm in short here and there's an imbalance, 10 points beneath us, I'll use that level to take out profits or to trim some profits or move my stop to break even. These imbalances can be used for a lot of things, like whether you use it as a stop loss level and validation, whether you use it for an entry. They're just key levels on the chart based off level 2 data. And instead of just random boxes and lines, you actually have some real data to back up your levels. Even using it on a higher time frame to confirm how strong the supply or demand level is super key, right? Right here on the 30-minute chart. And if I see a big ass candle form a demand level with 4,000 delta and all this fucking volume, I know it's a super strong level versus if I see a demand level made, right? Let's see if we can find one. If the delta isn't super high, or this is super strong supply. Look at that volume, look at that move down, or the volume isn't high, the delta isn't high, then I know it's a weaker level and I shouldn't be paying too much attention to it. One of my favorite ways to actually use these levels is to trail out positions. Let's say I'm in long, right, and I see an imbalance being made. I can start moving my stop loss. So right here, we're in long, imbalance made, new stop loss, right? Price keeps going up, holds the imbalance, new imbalance is made, new stop loss, right below the imbalance, and just keep trailing it out and out like that until we see, right here, buy imbalance. Why is this not reversal imbalance, right? It's at the bottom of a candle and it's a buy one. So this means it's a continuation. If this is a red imbalance, it would have been a reversal, but we do have a single tick below anyways, but continuation, put our new stop loss right there, right? New stop loss right there, new stop loss right there. And you just keep going and going and going until eventually there's no imbalance right here, nothing to trail out, nothing to trail out. Obviously, you're not gonna hold for that long. New continuation right here. This is off of data, I think, and you would have gone stopped out the same candle. So you can trail out with imbalances, you can enter with imbalances, you can use them as take profits. Most importantly, what I want you to get from this video is how important it is being able to see volume per tick and see the aggressive buyers and sellers per every single tick of any time frame candle, guys. That's it for this video. If you enjoyed this video, make sure you leave it down below in the comments. Give me some ideas on what you want to see next. If you have any questions or want to make a different, more in-depth video on footprint charts, I'll be happy to do so, guys. I appreciate you watching. Please subscribe. It's all I ask of you. It costs you nothing and it helps me keep going. I'll see you all next time, guys. Peace out.